Hi, this is Nahid Roni, and I'm again for some finance strategic matters. And this is session 2. And then I'm covering learning objective 1, which is understand the role of financial information in business strategy. So hope you enjoyed the last session because I covered the learning outcomes 2 of the ratio analysis, which focused the published financial statements analysis for strategic decision making. This session normally covered all other 3 sessions, the highlights of the other 3 learning outcomes. So the session objective of today is the role of the financial information, which is called financial data in our business strategy. So that's the main learning outcomes of the finance for strategic managers of this course, unit 7. And then scope of the session today is understand the need for financial information in business, and we can identify the risk associated to financial and business decisions, and also we have justify the information which is required in strategic decision making. So why we need the financial information? What are the importance of a financial information? Basically, the financial information, the finance, is the heart of the business management, and accounting reports and financial statements are as revealing of the health of the business as like a pulse rate, because without pulse man cannot survive. So for surviving means the people have to have their pulse rate and the blood pressure rate, and that reports are in revealing the health of the person, and that's the pulse and the blood pressure, that's the financial information, that's the health of the business entity. So that's why we need a financial information, which is heart of the business management. And for the financial information, we need a data which transfer to the information. The data mainly the raw facts, which is like anything, any information is subjective or quantitative or qualitative information, raw facts without any context. That is just the numbers and text. That's a qualitative and a quantitative. So when it's transferred to the say discipline, that's information with context. It has to be processed in some systematic way, and when it is processed, then it adds value by the summarizing, organizing, and analyzing data. So that's the basic difference between data and the information in the business. So normally, if we think about the cooking any curry, so for example, raw materials. For example, if we want to cook a chicken curry, the chicken is a raw material. That's a very raw data. It is essential of here, and then when we add the recipe on that, that's our information and the knowledge, how much it should be added, how many grams, and then when we cook in on the hob or oven, that's the action. So that's like a data, information, knowledge, and action is a data action cycle. So when we have any quantitative or qualitative data in our business environment, then we process that data as knowledge, and then we inform that data and we take decision, that's action. So this is basically the action cycle of the data, information, knowledge, and action. So we need a data to evaluate, to compensate the failure or the risk of the business. No, research evidence shows that the poor use of data, of financial information or accounting information, was one of the main reasons that led to business failure. So if you have a raw data and you are not process that data in a systematic basis, that's a poor use of accounting information. That caused the business failure. For example, you need to identify your profit and loss, and your accounting information was not correct, and then that led to the business failure. The lack and misuse of accounting information contributes to the small large enterprise. That's also caused the failure. So lack and the misuse of accounting information properly with that valid justification with the knowledge and information, as I discussed the cycle of the data, knowledge, information from the data which cause the action. So lack of misuse of the accounting information which contribute to big failure for the business. And also there is a lack of quality of accounting information which is utilized within a small or big enterprises has a negative relationship with their performance. That means the quality of the accounting information, that's a bad quality of the accounting information which causes bad performance of the business and vice versa. So these are the basic risk which is cause failure, lack of business performance, shutdown. So if we not use the information, financial data appropriately in our business. So we use the financial information for our strategic planning and the financial forecasting. As we know, because we are doing the strategic management unit and we are doing this diploma, so we know that strategic planning is an organization's process of defining its strategy or direction, goals and objectives, and making decisions about allocating resources to pursue the business strategy. In order to determine the direction of the organization, it is always necessary to understand the current position, that is definitely the financial position, profit and loss, assets and liabilities, cash flow. These are the things of the financial systematic information and the possible avenues through which it can pursue a particular course of action. And the financial focus is an estimation of future financial outcomes for a company using historical internal accounting and sales data. In addition to external market and economic indicators, a financial focus is an economist's best case of what will happen to the company or business in financial terms over a given time, particular period of time, which is usually a 1 year base. Normally the regulation is 1 year. We need to submit our business position to the HMRC, but any business can follow any period of time to forecast financial plan or to plan a strategic planning. So there is a loads of financial information, and then who uses financial information for what purpose. If you see, there are the two types of stakeholders in our business environment. There's the primary stakeholders who has a direct relationship with the business. For example, all the employees, directors, shareholders, suppliers, because they have a direct relation with the business, suppliers, customers, builders, local planning authority, bankers. These are all the primary stakeholders because there's obligations and they have an agreement with the business and with the contractual relationship. That's the primary stakeholder. They need the financial information. For example, if a bank needs financial information to lend money to that particular business, or what's the current position of the business, what is the financial position of the business, assets and liability, profit and loss, regarding everything. So suppliers, customers, if I want to make an agreement with this company, I need to see the solvency position of the business. So these are the primary stakeholders of the business who has got a contractual relationship with the business. They need the financial information. And then there are secondary stakeholders. They also need financial information. For example, environmentalists, local residents, local schools, local authority, councils, the competing business, highway authority, police. These organizations, they have a non-contractual relationship with the business, but they have some kind of interest with the business. So they need the financial information. So in the business, we do have internal information, and then we need to publish some accounts in the public. That's external information. So there are some stakeholders, primary and secondary, and they all need that financial information for different purposes. So final data, the validity of the financial data is whether the data measures what it's supposed to measure. So data is anything. So when it's classified in the definite term, then it's classified as head, and which is crucial and very important to making well-informed decisions in the organization. And then financial data is always derived from many sources, processed and in many ways, and then used by many people. As we've seen, there's a different kind of stakeholders, internally and externally. But there is a lot of mistakes. This means that there are many chances of errors, because many people can use the data of the different purposes. So capturing the right data at the right time, processing it reliably and correctly, and then sharing it in a timely fashion with the right purpose is a fundamental to an organization's financial control. So because we are talking about the financial information for the business strategies, so definitely there is internal control. So one of the main factors of the organization, control of data, and which data can be used for what purpose. That's the most important things. And organizations often have to decide between the timeliness and accuracy and appropriateness of the data. Taking too much time or too long to capture any and process the data, as we're summarizing and interpreting the data, may mean that it reaches the decision makers too late. A balance is always necessary in order to gain the maximum benefit in a timely manner. And then the financial management, we know the financial data, which is processed, summarizing in managerial aspects, that covers the 3 sections. First is analyzing the financial data, processing the data, and then it's transformed for the budgeting and forecasting organizational goals and objectives. And then from here, management can decide the financial proposals internally, or the external stakeholders, they can evaluate the financial proposal. So these are the 3 sections or areas which cover the financial management. And then the accountant main is accounting division, accounting department, and the main accountant. And then the role of the main accountant is to check the financial data and information, and they need to summarize and they present the data in timely manner in the correct head, and analyze the data and interpret the different kinds of accounts for the benefit of the owner of the business and the interested parties. And there is 2 types of accountants in the business. Normally in the company, there is a financial accountant concerned with the external reporting, which report can be used for the external purpose, investors, bankers, stakeholders. And then there is a management accountant who concerned with the internal reporting. So 2 types of accountants in the business: financial accounting for the external reporting, and internal reporting, management accountant. And then financial accountant's role to see the financial transaction are recorded properly, extracts information from accounting records, and prepares year-ending financial statements. Sometimes the financial accountant needs to produce periodical financial statements for the emergency basis. So these are the main functions of the financial accounts, because we need to understand what is the accountant's role for the business, and then what kind of functions and activities they're working to produce accurate reporting for the external or internal stakeholders. And the management accountant who looks after the information about cost, basically the labor cost and overhead cost, and internal cost of materials, cost of goods sold, labor, other expenses and expenditure and overhead, and interprets all the costs and prepares reports for the owner managers. So these are the management accountants normally preparing all the data and then report for the internal management and for the effective business plan and for forecasting, and what is actual budget and forecasted budget, and then if there is a variance. So these are the managerial accountant role in the business. So there's a difference of the financial and management accounting, and there is a difference of the financial and cost accounting. So financial and management accounting difference, primary uses a differently. Financial accounting external, because for the investors, governments and other authorities, creditors, suppliers. And then management accounting, that reports only for the internal managers of business. The purpose of the information for the financial accounting to help investors, creditors, and others make investments, credit, and other decisions. And the purpose of the management accounting for produce internally report, help managers, and plan and control business operation. And there is a restriction of financial accounting to follow the generally accepted accounting principle and other criteria, but there is no formula. It depends on the internal management, and it's very judgmental. Depends on the management accountant, and that sometimes the financial accounting historical and derived, but the management accounting reporting is based on the current and future prospects. The nature of the information of the financial accounting, the objective is auditable, reliable, consistent, and precise. And then management accounting information is more subjective, non-auditable, normally internally audited, but then judgmental, valid, and relevant and accurate. The scope of the financial accounting is highly aggregated information about the overall organization, and then for the management accounting, that is aggregated information to support local decision. So these are the difference between. There are some more differences between financial and accounting and the management accounting. So if we understand what is the basic aspects of the accounting of management and financial, normally the management is to manage the business. It is very much internally, and the financial is very much focused on the financial aspects, especially on the external, to attract the external stakeholders, investors, creditors, and other stakeholders for the finance purpose. So these are the basic difference between the financial and management accounting. There is also difference between the financial and cost accounting. As we can understand, the financial is very much external purpose uses, and I have to be very meticulous and very periodical. And the cost accounting provides information of ascertainments of cost to control cost and for the decision making of the cost. And the financial accounting is like a big umbrella. It provides everything. When the cost accounting is context of the cost accounting is to provide the cost, overhead expenses, sales, cost of goods sold. These are the things that are main purpose of the cost accounting. And also cash flow is one of the main aspects of the cost accounting. So normally the financial accounting classifies records, presents, and interprets in a very conventional way, and then cost accounting classifies records, presents, and other things in significant manner, materials, labor, and overhead cost. It records all historical data of financial accounting. Cost accounting records and presents estimated, budgeted, and other both of historical costs and predetermined cost. Normally, the financial accounts shows the profit and loss, income statement, and the cost accounting shows the details of cost, profit of each product, loss of each product and process, first in, first out, last in, first out. All the costing are associated with the cost accounting. They are prepared for a definite period for the financial accounting, and the cost accounting prepared as and when required, any time for the purpose of the business estimation. And then external users like shareholders, creditors, financial analysts, government, and agencies can use the information for the financial accounting, because as I said, is highly prepared for the external stakeholders, and normally the cost accounting reports used by the internal management at different levels. So these are the basic difference between the financial and cost accounting. Now, what is the financial information system? As we can see, there is lots of data are gathering in the business, and then there is accountant, management accountant, cost accountant, financial accountant. So what is actually the financial information system? So all accountants are gathered the information, and specifically the financial information in a system is a type of business software used to input, accumulate, and analyze financial and accounting data. So it's a system which is include all kind of data used as accumulation, analyzing, preparing, summarizing, and normally nowadays it's the software traditionally it was a manual pen and page and register ledger. But now there is a different kind of financial information system software in the market, and then the company are using that software to input, accumulate, and analyze that financial and accounting data. And then it's very effective and helpful for the business because it produces reports, and that's very important. As part of the assignments, you are producing different kinds of reports for the stakeholders. And here, this produce the reports, accounting reports, cash flow statements, and financial statements. That's a profit and loss accounts. And then the output of produce helps in making good financial management decisions, thus helping the managers run in the business effectively. And that's the need and importance of the financial information systems for the business. And then financial management system provides financial information to all kind of information to financial managers within an organization. And then this is a process and procedures that is used by an organization management to exercise financial control and accountability. And then this is a system support financial managers, different kinds of decisions based on all payments and receivables transactions. These are the key concerns. Any kind of prepaid expenses, any kind of depreciating assets according to acceptable schedules, all kinds of transaction keeping track of liabilities, and then maintain income and expenditure statements. That's income statements for the profit and loss account and the balance sheet. Those are main aspects of the financial reporting. And they're keeping all records for up to date, maintain complete and accurate accounts, and minimizing overall paperwork. So these are the systems which a good financial management system can produce, and the feature and characteristics of the good financial management system. So we need a financial information to basically, if it's a business always heading for this profit, because when we have revenue or sales and then we deduct the cost, then we get a profit. And then here in this discussion today, so we are going to look what is income statement, what is a statement of financial position, cash flow statement, and forecast and variance analysis. And already we know who are the primary and secondary stakeholders of our business on the basis of contractual and non-contractual obligation. So that's why we need a financial information to produce different kinds of statements for the different purpose. And in order to monitor the profitability and for the planning and controlling, research found the using of financial statements information, profit and loss account, that's a income statement, number one, the balance sheet statement of the financial positions, cash flow statement, that's cash in and cash out, that's a statement. We will measure different kinds of ratio because that's covered in our learning objective 2, and you can see there is a presentation slide in your Moodle area, and everything, the formulas are there. So when you interpret the ratio, you can identify different kinds of productivity and performance on the basis of the calculation. And then when you identify the different kinds of variance in your budget analysis. So these are the basic financial information reports you can produce from the financial data, and then we will look what are these and how we can calculate to produce a good financial report. So first of all, the profit and loss account, which is typically called the income statement, and it is widely used. The income statements, not the profit and loss account. As this term, the UK's term is income statement, and traditionally it was called profit and loss account. So within this statement, we can see the different kinds of profit of the business, and then we can calculate the sales and revenue, and then we can calculate the profit and loss from the business. Essentially, it collects all income and expenses to the determined profit, and then in a trading account, we can see the gross profit and then the expenses directed to arrive at the profit. So there is a different kind of profit, as we can see one income statement for the next slide. And then we can see there's a specific period of time, but normally the 1 year or 12 months, but the financial accountant can produce on the basis of the weekly, monthly, fortnightly, half-yearly, on the basis of emergency. And then let's see one example of income statements. Here is the one example. So for example, 31 August 2016, the year end. And then we do have a cross profit when we see the sales and the cost of, when the cost of goods sold is deducted from the sales, that we can gross profit. And then when we deduct all kind of overhead expenses for the business, then we will get a operating profit. When we deduct the interest for the business, then profit before tax. When we deduct the tax, then we have our profit of tax. And this is a retained profit for the business when we pay the dividend, but we left over the figures and then we retain for the next year. That's a retained profit. So for the income statement or profit and loss account, we can have a different kind of profit on the statements. So we can understand from the income statement for the different kinds of profit. And now, if we have a different years, consecutive years profit and loss account, then we can project what's profits gone on, gross profit is increasing or decreasing over the years. So if you have a 3 to 5 years data income statement, then we can project and we can justify the historical data on the basis of our calculation, and then we can make some diagram pictorial increasing on decreasing trend. We can do some trend analysis whether profit is going or down, and then we can identify which expenses are increasing, what kind of interest, and what would be the dividends are paying from the business. So from this kind of reporting, we can identify different kind of profits and expenses, and then we can forecast the business for the next consecutive years, or the 5 years plan, or 10 years plans, or the short-term plan for the profit. Next is statements of the financial position, as the balance sheet typically called, and that it shows all kind of assets and liabilities of a business at a point in time. And then the difference between assets and liabilities is what the business is worth to its users, that is called capital, and then it consists of what they have invested in the profit made. Normally there is the accounting equation, so assets equals liabilities. Normally all kinds of assets, total of assets equals totals of liabilities plus total of capital. That's the accounting equation. And as we can see, these are the one of the very typical example of the statement of financial composition. An asset, this is the asset side and this is the liability side, and we have here you can see there is a non-current asset which is fixed asset, and we have a current asset which is very much liquid asset. In assets is a resources that may be used to divide the revenue in the future. The balance sheet divided assets into two categories, as we can see, non-current asset and current asset. Non-current assets which are acquired for the retention of the purpose of providing a service to the end and are not held for resale in the normal course of trading. And the current asset which are cash or other assets, and the stocks or inventory, accounts receivables, and held for conversion to cash in normal course of business. And so these are the very typical head of the non-current asset and current asset. So we do have a cash here, and then we have a capital account, and we have a current liability. We have a non-current liabilities in loans, and total is capital and liabilities. And liability is an obligation to pay money as a result of a past transaction or event. Again, it is divided into two categories: non-current asset and current asset. And then non-current liabilities and current liabilities. And non-current liabilities are due for repayment for more than 1 year after the balance sheet date, and current liabilities fall due to payment within 1 year. So here the statements of the financial position lay out the total assets should be equal to the total liabilities. And then from this kind of financial position, we can identify the non-current assets and current assets, non-current liabilities and current liabilities, and capital account. Here we can, if it is a capital, if it is a limited company, you can see the number of capital invested and then per share price, if there is information. we can see. And then from here we can do some ratio calculation, which is covered by the ratio analysis. So you can interpret your business or any other business, the capability of the solvency, performance, activities on the basis of this statement of financial position. These are the second example of the financial information for the financial data. Now, there is another important example is financial information cash flow forecast. And then it is income statements and a balance sheet is a business financial report should include a cash flow statements as well as the experts are saying, and this is historical view of the cash flow, not covered with this event. And then a cash flow, cash flow forecast is a projection or budget of how the cash in the bank is expected to move, and then it's very useful because the profit is only the one indicator of a business. To show the profit or loss depends on its sales and expenditure, and the business needs to generate cash to satisfy its bankers, to satisfy its short-term customers, to pay that it can repay any debt. So on the cash flow statements, we can understand, or we can see what's the cash position of the business. And then typical cash flow statements look like, so when we have a receipt and when we have a payments, because on our balance sheet or statement on the financial position, that's completely depends on the assets and liabilities. But that amount is always going to the balance sheet or the statements of the financial position. But in the cash budget or cash forecast, we can see the receipts. We can see only the receipts and only the payments. So when we see the data and then the sales or revenue, that's our 4 months historical data. Then we can project so what kind of sales we need for next year, and then what kind of payments we need to pay for the next 4 or 5 months. So the receipts, we have a data, we have a sales revenue, so that's our total income, and then we have to pay to our creditors on the basis of materials, wages, overheads, bank interest, purchase any fixed asset, loan repaid. That's our total payments. So when we have a total income and total payment, then we can have a cash flow. When we deduct the total payments from the total income, then we have a cash flow. And then if you have any opening bank amounts, then we can add that one, then it will give you the closing bank balance. So this is the importance of the cash flow projection to see the historical data of the cash flow, and then to see the further forecasting of the cash flow budget. Another important thing is ratio analysis, and then it has been covered in the learning objective 2, and you can see that I can explain all different kinds of ratio analysis with the formula and what is the interpretation. So ratio analysis is basically a mathematical expression relating one number to another and providing a relative comparison. And that number, this number is coming from either the income statement, profit and loss accounts, and the balance sheet. Because there is a formula, specific formula, and we need to pick that figures from the income statements, profit and loss accounts, so typically called, and then from the statements of the financial position. So the figure are coming from that financial reports, and then we can make the ratio analysis to see the company's position, financial position. And these ratios help to link the financial statements together and offer figures that are comparable between companies and across industries and sectors. So let's see what kind of ratios are in our management accountants. So normally the ratio analysis has been done by the management accountants, because normally these are for the internal performance and the external performance. But if somebody wants to see the company's position, there is a published accounts available in the website if it is a public limited company, and they can do and calculate this kind of ratio analysis or ratio calculation. So normally, if we have profitability margin ratio, that's gross profit, operating profit, net profit, return on capital employed. These are the profitability ratio, and the gross profit calculation formula is sales divided by gross profit multiplied 100. And this has been covered in learning outcome 2. If you see in the Moodle area, you can have the formula sheet. You have the lectures and the presentation slides, so you can do your calculation on the basis of this formula. This session, I'm not covering the formula of the key management ratios because it has already been covered in the second lectures. So on these ratios, you can have a gross profit ratio that shows you what's the gross profit of the year, and then you can compare and contrast between the year or over the consecutive years, or you can project, you can forecast your operating profit, net profit, and other things for your business. Financial ratio is saying that express the short-term solvency status of the company, and it means how quick the company can pay off its short-term obligation. It's quick ratio and current ratio, or sometimes it's called the quick ratio is acid test ratio, and then this current asset and current liabilities, and then the ratio tells you how quickly you can pay your short-term payments on behalf of the company. Activity ratios measure the rate of which the company is turning over its assets and liabilities. If the company wants to see your inventory days or stock days, it performs compared with the staffing level also, and also the debtors and creditors. So for example, stock days, that's how many days you can have your stock in your business, and then how many days you are expecting from the accounts receivables, that's the debtors time, and then how many days you are paying to your creditors payable time, creditors payable time, so that's the activity days. Then you can also see the sales per employee, and these figures you need to take from the HR department, the employees, and then when you divide it, sales divided by employee, then you can get the sales per employee, profit per employee. When you have the per share price, and then when you divide it by the sales divided by per share price, then you can have the EPS, earning per share, and then it's always measured by the pence of the share. So these are the key management ratios. You can have it, and then you can have it from the income statements and the statements on the financial position to calculate different kinds of profit ratio, financial solvency ratio, activity days ratio, employees ratio for the staffing level, and then investment ratio. And then the formula are available in your second lesson, and then you can have the calculation on it, and then you can interpret what is the position of your management. Now, there is another important is used for comparison variance analysis. When you have a budgeted amount, and then in your business, when you have an actual amount, then you can make a variance. So this is a utility consumption. When you have a cost, this is a cost. So you have a budgeted cost of 23,500, but in your actual amount you have a 27,200, and the variance is your 3,700 pounds. So this is called an adverse variance. Adverse is a negative variance, as it is a cost item which just exceeded the budget, so adversely affects the profit. And if the cost item were under the budget, it would be showed without the brackets or favorable. For a favorable, for an income budget, it would be vice versa, and sales exceed the budget, it would be favorable. For example, cost, if it is increased, that's adverse, and for the sales or any kind of income or revenue, if it is increased, that's the favorable. For the sales or revenue, if it is actual is increased, that's the favorable. For the cost or any kind of expenditure, if it is actual is increased, that's the adverse. So for the variance analysis, so we can have that information from the budget accounts, and we can calculate these things, financial information for the forecasting, what will be the happen or variance analysis, and what will be the strategic decision for the company. Now, measuring the variance, as we can see, the adverse and favorable terms, budget and actual figures. We have a sales budget, and you have a cost budget, and you have a profit figures. And then in actual, last year we have this sales, which is favorable, which is increase. Is I say that if it is sales and income increase, that's a favorable. And if it is any kind of cost increase, that's the adverse and unfavorable. Here, variable overhead is reduced from £4,200 to £3,840. That is £360. That's adverse. If any kind of cost and expenditure is reduced, that's the favorable. And any kind of cost and expenditure increase, that's the adverse. So these are variance analysis you can estimate from your financial information or financial data for to get the effective information, and then to decide the effective strategic planning for your business. So these are all kind of source of information data you can analyze by income statements, statements of the financial position, ratio analysis, budget, and cash flow statement. The different kinds of information statements, information you can analyze in a different way to report to internal and external stakeholders. So normally for the business, the management accountants have some responsibilities for internal controls. Internal control is the process which should provide reasonable assurance about the achievement of an entity's, that's the business objectives, with regards to the reliability of financial reporting, effectiveness and efficiency of operations, and compliance with applicable laws and regulations. So definitely it's one of the main aspects for the internal controls and the main responsibilities for on behalf of the management accounts. And there is a turnbull guidance for the internal control, well accepted in the UK system. The directors are required to make a statement that they have conducted a review of the effectiveness of the internal controls of the company. So they have a periodical meeting, and then they have the periodical assessment of the internal control and which kind of procedures a management accountant are following. And then this thing, one of the importance of the system of internal control is managing risk. That's one of the key aspects in the company and achieving corporate or organizational goals and objectives. An effective system of internal control can help safeguard shareholders, investments, and the corporate assets, and to assist in ensuring that operations are carried out effectively and efficiently. So there's a very important for internal control for the processing the information of the financial data in terms of financial information. So there are key aspects of internal control. The control environment. Definitely the business, and then all departments are interrelated with the business. The risk assessment process, so what kind of risk assessment are going on. Information system, as we described and defined the information system with the financial data. What kind of control activities are going on in the business, and what kind of control activities are taking on behalf of the management to prescribe a good strategic decision in the future. Control procedure and monitoring of control. These are the all key aspects of the internal control for the management decision for the effective financial strategic decision on the basis of financial information and financial data. And then there are major categories of financial management, because we are talking about the management accounts and the financial management. So if we see the different sections and different aspects and different categories of the financial management, that are the cash management, which is include the cash budget and cash flow statements. Investment management, which is very much associated with the ratio analysis. Capital budgeting, which will cover in the learning objective 3, which is a net present value, future value, internal rate of return, annual rate of return, and the financial planning. These are the major aspects of the categories of the financial management, and then that will be covered in the different session in the next 2 weeks, and then you can accumulate this kind of aspects in your task, because you have to produce 4 different tasks in your assignment, and that has to be covered systematically on the basis of the financial data. The cash management, as I said, the systems collect information, all kind of cash receipts and payments, which is obviously the cash flow statements, which is cash inflow, the receipts and cash outflow of a company on real-time or periodical basis. And then you can do it so daily, weekly, and monthly as a business owner. And then cash budget forecast, cash flow forecast is one of the example on each. Investment management, many businesses invest their excess cash in short-term, low-risk marketable securities and higher return alternatives, so that investment income may earn until the funds are required. And investment information and securities trading are available from hundreds of online sources where to invest on the internet and other networks. Online investment management service help a financial manager make a billing, buying, selling, and a holding decisions of each type of security, so that they can optimal mix of securities develop that kind of information, financial information, minimize the risk and maximize the investment income for the business. And then for this investment management analysis, you can take the ratio analysis to see what kind of activities going on the basis of cost profit analysis, ratio analysis, and then solvency analysis, activity analysis, investment analysis. And then the management can decide if there is excess amount of retained profit, they can invest that amount to the other securities or other investments. There is also the capital budgeting system. So if you have a good financial data and information for the financial forecasting. So if you do want to do a good strategic decision on the basis of the financial information, so if you have a finance for good strategic decisions, so the capital budgeting is one of the technique to process involves evaluating the profitability and financial impact of proposed capital expenditure. So for example, the long-term expenditure proposal, plans and equivalents, so the definitely what is the future value and the net present value, future value, internal rate of return and annual rate of return. That will be covered in the third learning outcomes in the next session. And then if you can do capital budgeting by using this formula, then you can estimate what is the future value of today's investment. And then that capital budgeting needs your financial information and financial data of your business, and that should be authentic and reliable. And then financial forecasting and planning concerning an economic situation, definitely there is always a mega environment outside which is uncontrollable. Business operation types of financing available interest rate, which is decided by the government, the bankers, and the stock, and the bond prices to develop an optimal financial performance of the business. So that's a strategic decision for from the business of the concerned business manager can take a financial decision on the basis of the financial information. So that's the whole aspect, which basically the financial management. We need to know what will be the ultimate objectives of using the financial data and financial information. The basic is to optimize the profit. The business wants a profit. The more the profit, the more the business will expand. And then obviously we need to minimize the cost and expenditure. Well, the more we reduce the expenditure, the more we can save the money. We need to maximize the market share. We need to expand our business. We need to expand our customers. We need to maximize our customer share. We need to maximize the current value per share of the company's existing stock. We need to increase the earning per share. As we can see that we have a earning per share, investment ratios. We need to increase the current value per share. We need to maximize the market value of the existing owner security. So these are the actually goal of the financial managers specifically, and then because we are doing the finance for strategic managers, so these are the goals we need to accumulate. We need to focus to our business to maximize profit, minimize cost, maximize market share, maximize current value, maximize the market value on the basis of the financial information and financial data of the business. And that financial data and financial information coming from the financial statements, which is profit and loss account, with statements of the financial position, which is called balance sheet, cash flow statements, and then if you have a variance analysis, actual and budgeted amount, and then we did one kind of budgeted expansion from the basis of our financial data and information. So if you see our assignment, we need to complete some tasks in our assignments, and then our proposed company is Samsung PLC, and then you are working, there is a hypothetical environment because you must produce a presentation for a patron to use at the next meeting of the Chamber of Commerce. So you're working as this company, and then for this today's session, you can understand what is the need and importance for the financial information and data for the business. You can identify some risk, why if you can't accumulate that financial data for the importance, you can justify some risk. And you can summarize what kind of financial information required in strategic business decision making. These are the scope of today's session, which will be already covered. And then now, task 1 is you must produce a presentation for Patron to use at the next meeting of Chamber of Commerce, and the presentation should be based on your research on the Samsung PLC and other relevant information. If you go to the website of the Samsung PLC, you can download the relevant information, income statements and statement of financial position, and then you can complete by the supporting notes. Your presentation must include the following: an evaluation of the sources of financial data and which can be used from inform business strategies. So sources of financial data, say, which is you can use from the annual report. So if you go to Samsung PLC and you can download the annual report of the Samsung PLC website, then you can have some sources of financial data, and then you need to evaluate why you are using those sources of financial data for what purpose. You need to say something about the assessment of the need of financial data and information in relation to the formulation of business strategy. You need to say something risk, because this has been covered in this session, and then analysis of the risk related to the financial business decision. Also, you need to overview all the aspects of your sources of data, and then evaluation and then assessment and analysis of the risk. That's a review. You need to say something about the methods, what kind of internal control or the control of the procedures that can be used for appraising strategic capital expenditure projects. If you want to do any expansion, any strategic vision, or any kind of projection, and then strategic direction, you need to say something about the methods, why you are taking that kind of capital expenditure projects or strategic direction. You can have some information of the website of Samsung PLC annual report and the home website of the Samsung PLC of their strategic capital expenditure projects and other strategic directions for this review of methods. So these are the points you need to cover in your task 1. So you can do the presentation, which I require. So on your presentation, you need to have some notes for each of the presentation slides, because you are submitting one presentation for the task 1, and each of the slides needs the notes. So because on your presentation you are pointing only the bullet points. On the handouts, on the below of the presentation, so you need to include what kind of information you are telling to your audience as a presenter, because you are a presenter and you are presenting financial data and strategic decision making of Samsung PLC. So on your bullet point, that's fine on the presentation slides, but in your details, you need to include what kind of information you are going to tell to your audience. That's your Pietro Ion in the Chamber of Commerce meeting. And then you have to say something that the risk analysis, what kind of information are risky, and then you can't judge any financial business decision. And then your projected capital expenditure projects and strategic direction, you need to say something about what kind of methods, that means what kind of financial data and information. And the methods like an ratio analysis and capital investment decision, cash flow statement if you have any, and then if you do any of the income statements, different kinds of profit projection, and if you take kind of asset and liabilities position, they need to show something, the methods of these presentations. So what I can suggest you, so when you finish all the lectures, then you write down task 1, because task 2 is a very straightforward. You need to do some ratio analysis and you need to focus some interpretation. And then on your task 3, you need to show the business assessment on finance and non-current assets, investment and working capital. So when you finish on task 2, 3 and 4, then you can make your presentation, task 1. That will be helpful because already you have the information from task 2, task 3 and task 4, and then you have some calculation, and then you have some figures, financial figures. Then you can estimate the methods, and then you can focus on analysis and assessment and evaluation on your presentation. So that's all about the Tuesday session, which is covering the understand the role of financial information in business strategy. And for this session, you need to cover one presentation, which information are available in your Moodle area. That's specific assessment and then assignment, sample assignment. And if you have any query, my name is Roni, and this is my email address, drroni@ukeversity.co.uk, and you can call to our Ukeversity office number between 10 a.m. to 4 p.m. GMT anytime, Monday to Friday, and then I can able to pick up your phone call. And if you have any specific query, you can always email me. And then hope for the best and see you in the next session, and enjoy the Finance for Strategic Managers units. Thank you.